Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Sorry about the audio the other day. I'm not sure what happened on that video. You got to turn it way up if you want to hear what's going on there. Hey, today I'm talking to my baby boomers. Look, Fidelity says that 57% of you need to rebalance your investments. You're taking too much risk through no fault of your own, but only because the markets have done so well. And the way I read the article, it was like, okay, well, they're not really teaching anything here. Let's see if I can help people understand what they mean and why you may be in a little bit of trouble here. If you're a baby boomer, 1946 to 1964 birth years in there, let's see if we can help you out a little bit. So to do this, we're going to start by going over to a little chart here. I want to just show you real quick. This is the S&P 500 returns, usually used as the benchmark for performance of stocks. And then also you see the Barclays U.S. Aggregate Bond Fund or Bond Index. That's usually the benchmark used for bond funds if you happen to be invested in those. So what you can see here is, well, let's go back over the last 3 years. So if we look over the last 3 years, you got basically a 50% return up here, in the middle there, 50% return on the S&P 500. You also have about a 12% return on bonds. So let's just use an example here, right? Over the last 3 years, well, or let's say 3 years ago, you decided to start investing, right? And you decided 3 years ago that you were going to invest $200,000, right? So we'll say that was your starting amount. You put $100,000 in stocks, so 50% of your money in stocks, and you put $100,000 in bonds. So you got 50% there as well. In the financial world, what we would say is your allocation is 50-50. You're 50% stocks, 50% bonds. Now, the target allocation is also 50-50, meaning we want to stay as close to that target as possible. Here's the problem, though. You just saw on the charts there that your stocks did really well. They added, say, 50%, and your bonds added 12%. So what really happened here is 3 years ago, you started with the best of intentions with a 50-50 split. That's very conservative, by the way. And now you have $150,000 in your stock portfolio, and you have $112,000 in your bond portfolio. So you got $262,000. So what happened is you sat back and enjoyed the ride for the last 3 years, but what's now happened is you've got about 57% in stocks and 43% in bonds, right? So you got $262,000 now, so you're happy with the returns. You don't think anything of it. You didn't check in for the last 3 years, but now 57% is in stocks. But what's happened? 3 years went by. Let's say you were 60 3 years ago. You are now 63 and should be taking less risk. But in reality, because the markets in your investments had appreciated, you are taking more risk. What happened is your stock portion of your portfolio had such a nice run relative to bonds that all of a sudden you have more of your money in stocks than you really set out to do in the first place there, that 50-50 mix. So we have to do what's known as rebalancing. And all we do is we simply take 7% of the 150, and if that's in a fund or whatever you have, a group of funds there, you sell off 7% of your 150 and you put it over to the bonds. That brings you back to 50-50. The reason we want to do this is because you have 57% stocks. That's 7% more than you had 3 years ago. If things crash a little bit, you're going to notice you fell faster than you went up. What happened? Right? It's because you have a bigger stock position. So general rebalance rules of thumbs here to give you something to take away. I tell customers you want to rebalance when you get 5% or more out of whack. Now that's in your 401ks, 403bs at work. You're limited by the number of rebalances you can do. You can set up an auto rebalance, and I think they do it once every 6 months. Or you could just hop in there and do it yourself, but you're limited to the number of transactions you can make. So I say when you get to about 5% away from your target allocation, go ahead and do a rebalance. If you find that 6 months has passed and you are 1 or 2% away, go ahead and take the advantage of rebalancing because you're really limited to so many trades in that window. Use them up, right? Go ahead and rebalance. So 5% and or a 6-month window where you have the ability to make those trades. If you switched funds somewhere along the way or they introduced a new fund and you made an adjustment, you may not have that available trade. You'll have to check with them to see. But that's the bottom line. My baby boomers, you very likely need to start looking at some kind of rebalance Not because anybody's trying to scare you and not because we're fearful of the market, but simply because the market's done so well that now you're probably out of whack. So I hope that helps you. If you don't find anybody that's willing to help you, I hope you'll keep us in mind at Jazz Wealth. We're teaching advisors. We just love helping to teach. We do weekly classes for customers, and we also do a 5 o'clock show that's live on our YouTube channel called The Closing Bee. I hope you'll join us for that. It's every day, 5 o'clock. It'll be a little bit later today, so I hope to see you there. I appreciate you watching. If you would, hit the subscribe button. I'm supposed to say that. Doesn't hurt you. Doesn't help you. Just lets you know we're there. Appreciate it. Enjoy your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.